Welcome back to Squawk on the Street. Corvex Management Founder and Chief Investment Officer Keith Meister joins me now from the 13D Monitor Active Passive Summit. We've done this a number of times. Good to see you.
Great to be back with you, David.
Love to start off on the broader market. Obviously, you've been an investor for a long time now. You're not a young kid anymore, Keith.
We launched Corvex almost 14 years ago.
Yeah. So give me your senses to the market. You know, we obviously speak a lot about, as I think is appropriate, AI and the ecosystem around it and what it's doing to so many of the names that we well know. But there is another market as well. I'm sort of curious as to how you're viewing it.
Yep. So if we look back and think about the market this year, I think it's been a lot stronger than I would have thought as we entered the year. We had great returns, and markets had strong returns in 23 and 24. And the narrative entering 2025 was you can't keep spending $7 trillion if you're only bringing in $5 trillion. And at some point, the equity market would have to listen to the bond market. Now, fast forward till October, and the 10-year yield is below 4%. So the bond market has allowed the administration to keep spending. And why is that? You know, in the beginning of the year, we were talking about Doge, and you were worried about having
remember Doge?
Yeah, no one's talking about Doge anymore. No. But instead...
By the way, we're having a government shutdown, which nobody seems to be talking about either.
But what are people talking about, right? You have oil at $60, which is massively deflationary. What else is cheaper today than it was 10 years ago? You've had this AI boom that you're talking about, which has driven lots of productivity and also been
we get to see a lot of the productivity driven.
Yeah, but it'll be deflationary. It will drive productivity. I think you are seeing the productivity in business. You're maybe not seeing changes to labor, but every company...
We were just hearing the CEO of Coke talk about how much cheaper it's going to be to make ads, for example.
And companies are using AI to drive efficiencies in their business. So the combination in some form of these two things has allowed the government to kick the can and keep spending. And in that environment, they got the OBBB done. And that's spending lots of money, but there's a hope that it'll cause accelerated revenue, accelerated GDP growth, and you'll have productivity. And you can believe that there's a story around we can grow our way out of this. And right now, the equity markets are looking forward and believing stories. There's a once-in-a-generation technology revolution occurring with AI, and everyone's betting that all the people who are in that market will be winners. Now, the AI market's gonna win. It's gonna change the world. But in the fullness of time, just like the internet, just like cloud, there'll be winners and there'll be losers. And right now, the market's not yet differentiating, but wanting to believe every story. So we have a stock market that's doing great, that's very forward-looking, that's thinking about TAM, that's thinking about accelerated revenue growth, that's thinking about stories.
40% of the S&P is 10 companies.
100%. But then there's everything else that hopefully we can have an edge investing in. And thinking about trying to buy really high-quality businesses at reasonable valuations and then acting as an owner and taking advantage of market structure. So much money wants the next data point, so much money is short-term that we can buy amazing companies at reasonable valuations. So taking example, I've heard you talk on your air about Union Pacific and the transcontinental rail merger.
Yes.
You know, if I was an activist, if I could design anything for a railroad to do, I'd say hire Jim Vena and do a transcontinental merger and change your business model. And you could buy the stock after all that was announced at a lower price than the year started. So you can buy an amazing business like Union Pacific, and we can debate in 3 years, does it do $20 or $25 of earnings? And we can debate at that time, is it worth 20 times earnings, or if volumes are growing, is it worth 25? But is it a $400 or $500 stock that you're buying at half that price today? Or we could have the same conversation about Disney, or we could have the same conversation about restaurant brands. There's a whole bunch of wonderful companies we're owning that are going through change, that are being well managed, that have people in the boardroom acting like owners at valuations less than the stock market.
Right.
So I think in this market, it's surprising to me that you can buy great businesses at reasonable valuations when the S&P is, you know, at an all-time high.
When it's at an all-time high and trading at a fairly high multiple as well, historically.
You know,
very high.
By the way, you know, valuation tends to be a very bad tool to predict returns over the next few months, but a very good tool for projecting returns over the next few years.
Right.
So,
right.
Yeah.
You know, we're here at an activism conference. We've talked before. You're a frequent guest here as well. Do you still consider yourself an activist investor?
You know, we don't think of activism as a strategy. We think of it as a tool. And I'd love to change the word activism to acting like a business owner. So when we buy a stake in a company, we buy 2%, we buy 5%, whatever the ownership interest is, we don't think that we own a piece of paper. We think that we own a piece of a business. And then we want to act like an owner and help that business be more valuable. But our strategy is to invest in high-quality businesses going through change, and sometimes we can use the tool of being an active investor to add value. And
but is it worth the fight? I mean, I wonder, is fighting worth it at this point?
My view, no.
Yeah.
There's lots of ways to do activism. For us, it's not about having fights. For us, it's about investing behind good management teams and good boards, and we can add some value and help them be a better public company.
So why isn't it worth the fight?
Why is it?
Yeah.
Because capital, there's so many amazing businesses that if you have to convince a management team that they're doing something wrong and you can't make your idea their idea and sell it to them, it's probably a team you don't want to put capital behind. I'd much rather back a great management team who knows how to run their railroad, do their mousetrap, but may not understand how to balance the different priorities of different stakeholders, how to think about pacing, rate of change, how to be a better public company, how to match. Management's got a great strategy. What's the right structure? What's the right capital structure? What's the best way to take advantage of that?
Right.
And help good companies be better public companies, reduce their cost of capital.
It's interesting. So if you can't find somebody who's willing to allow you to be collaborative with them, you're more likely to say forget it as opposed to try to run a proxy fight or anything like that.
100%. Yeah. We did one going way back. You'll remember with Related, Commonwealth, 12 odd years ago. We did one, real fight, and we made a good return. It was massive hard work. We spent $37 million in legal fees. It's not worth it. Life's too short. I'd rather buy a great business, partner with management, and help it be better.